Yeah, so what is your question?
So like in the sales, you are taking the example of Alibaba shares. Like if the company is selling the shares of Alibaba, it will have to make the sales in the case of front office. So I'm asking.
No, I didn't talk about that. That's not sales. That is, you're talking about the primary capital markets function.
Front office role, like sales you have said.
So front office roles we have talked about. Sales, that is under what kind of function, guys? Let's recap this. If he's talking about what are you talking about? Sales, trading and research.
Yeah.
So that falls under what kind of atomic level function?
Front office, sales, trading and research.
What are you saying?
Sir, IBM.
But that falls under what kind of I have listed the prototypical firms, these are the atomic level functions. Okay, under which of these functions is sales, trading and research? In the secondary capital markets, I said that secondary capital markets, the function is under what kind of activity listed here? There's a bunch of activities listed here. There's a bunch of activities listed here in column C.
Yes, sir.
Which of those activities did I say that secondary capital markets is like? It's just a subset of those activities. What you got the answer on the next column itself. In the next column itself, you can see that. Are you following my question? He's asking a question about sales, trading and research. Market making operation. So what is that secondary capital markets business? It's essentially a market making operation. So it is based at the heart of that operation is the trading desk, and they are supported by, the trading desk is supported by,
Front office, back office.
trading desk is part of the front office. But what did I mention? It's a market making operation, right? Secondary capital markets operation is a market making operation. So it falls under this category of the general market making operations. What does it say here? What does it say here? Let's roll it up a little bit so that people in the corners can see it. What does it say here? Market making in?
All asset classes.
Including?
Secondary capital markets.
Okay, so that's a subset of all asset classes, because in secondary capital markets you have only debt and equity. Okay, so but you have to understand that a secondary capital markets operation located inside an investment bank is actually nothing but a market making operation. As an atomic level of core function within the financial services sector, it's actually a market making operation. So the heart of the market making operation is the trading desk, because they are the guys who are making prices. Is this clear? Now the trading desk is supported in this activity by which two types of functions?
Research
Research and sales, right? So this is the operation that you have to understand. So a typical market making operation. So when you can see this manifested in two types of settings. You can see this in a typical secondary capital markets operation within an investment bank. Okay, so you will see a trading desk which is trading in equity and debt securities. Okay, and making markets in equity and debt securities. And it is being supported by sales and research, which are also focused on those types of assets. So you will have, this is where your equity research comes in, right? Where you hear about all these equity research people. Okay, you hear there are many high profile jobs in equity research, right? So this is where equity research fits in. It is in the front office of the secondary capital markets operation, and it is supporting the trading desk actually. So the function of equity research is essentially to inform the institutional investors, mainly targeted at institutional investors, to give them input, to give them sufficient input so that they can form a view on the stock. Okay, so that whether you should buy or sell a particular asset. So that's what equity research is doing. But if you go to a commercial bank, like if you go to a Standard Chartered Bombay office, you go to the treasury of Standard Chartered Bombay, that's a commercial bank. That's not really an investment bank. Okay, if you go to a commercial bank treasury, there also you will find a market making operation. So it is fundamentally the same operation. So there you'll see a market making operation mainly focused on foreign exchange and money markets. Okay, foreign exchange, money markets, and it could also be focused on commodities, but that is a little bit less common. Okay, but mainly if you look at foreign exchange, which is one of the most important markets in the world, so you'll see a foreign exchange. If you take the example, so the point I'm trying to emphasize here is that when you see a secondary capital markets operation, a trading operation, or a secondary capital markets operation, sales, trading and research inside an investment bank focused on equities and debt, and then when you go to a commercial bank treasury operation and you see a foreign exchange trading desk, that will also be supported. You should have the basic abstract concept in your head that this is a market making operation, so it will have traders at the heart of the operation, and it will have sales and trading, sales and research to support it. So when you go to a commercial bank treasury and then you see the foreign exchange trading desk, you will see that they're also supported by foreign exchange sales and foreign exchange research. And the job is, again, the customer base is a little different. There will be some overlap in the customer base, that they're also talking to institutional investors, okay, like international investors who are investing across borders. They have to deal in foreign exchange, okay. And then, but mainly they'll be talking to corporate customers and also, asset managers, fund managers, hedge funds, alternative asset managers who want to trade in foreign exchange. So this again, but the point is that you have to, are you following what I'm saying? That you should have this abstract concept in your head of a market making operation, which is basically at the heart of which is the trading desk, and then that trading desk is supported by sales and research. So you could now take this abstract concept and apply it to a secondary capital markets operation, okay, in an investment bank, or you could take the same concept and apply it to a foreign exchange trading desk in a commercial bank treasury. Like you go to a Standard Chartered treasury or a HDFC treasury or Citibank treasury, you see the foreign exchange trading desk conceptually is the same. You have a trading desk focused on a particular asset class, in this case foreign exchange, and again they are supported by foreign exchange research and foreign exchange sales. So you'll have, and as I mentioned to you, sometimes because foreign exchange is such a big market and so many players are involved, sometimes you can get really specialized. You can have people who are doing FX, you can have actually large teams handling FX option sales. So if you go back to our framework, that means they are located in just that one box. Under foreign exchange, they are under currencies. We can open that framework also just to see. I mentioned this earlier, so you shouldn't have to redo this because it's all captured on video. But anyway, the point I'm trying to emphasize is when you get very big markets, specialization is a function of size. If you have tremendous amount of volume, then you can afford to specialize, okay? Because the volume in foreign exchange, because foreign exchange itself is such a massive market, and so even foreign exchange options have become quite big. So therefore you can actually have a sales team that is purely focused on foreign exchange options. So they don't sell any spot FX business, or they don't sell FX swaps or FX futures, any such FX forwards, or they purely focus on selling FX option products. So what will they do? There will be an FX option trading desk within the larger foreign exchange trading operation. There will be, again, if you have trading in currencies, if you have a foreign exchange trading desk, okay, this is currencies, you can trade in so many different instruments. Are you following? You can, any asset class, you can trade in so many different instruments. So within a larger foreign exchange trading operation, you can have a spot trading desk, a forward trading desk. Are you following now? Because these are all different instruments. What happened? Why is everybody looking like a zombie?
Yes.
Am I making sense or not?
Yes. Yes, sir.
Because what did we mention? That anytime you see prices for any of the asset classes, any market, it is always the price of some instrument.
Yes.
Either some instrument, either you're looking at spot prices or forward. You don't have just abstract prices. It has to be the price of some instrument, right? So there are all separate markets within each of these. There are kind of separate kind of supermarket kind of structures. So you have a separate supermarket for FX foreign exchange options, okay? And so that kind of structure. So therefore you can actually, you will have within a larger foreign exchange trading operation, okay? You will have a separate option, operation, which is a subgroup of that, which will be FX option trading. So you'll have the FX option trading desk in that setup. Are you following?
Yes.
Okay. So then again, the FX option trading desk will have its own specialized sales and research functions. So you will have FX option research within, you'll have some people within the FX research team who specialize purely on FX options research, and they are going to feed the research to FX option investors, people who want to trade in FX options, either corporate customers or institutional customers who are going to trade in FX options, and they will feed them research to help them to formulate a view. Is this clear? So you have understood the function of sales and research, how they support the trading desk. Because essentially the trading desk has to have volume. Okay, so remember market making, what is the hallmark of market making? What is the market making one? Sorry?
High volume and low.
High volume and low volatility, okay, low price, limited price movement, high volume. So they have to get the high volume. So the job of sales and research really is to generate that volume for the trading desk. So the more interest you can create in a particular type of product, the more the investors would want to trade that kind of product, and that will generate volume for the trading desk. This is clear? Okay, so this is the setup. Right, so what is your question? You mentioned, so first of all, so get all these points clear. Okay, so this is all part of the front office. Within any market making operation, you have a front office, yeah.
Like these are the companies which you are taking in Facebook, Alibaba, all are big companies.
Yeah.
So they do not have to make more efforts in selling their shares. But what will the other companies do to make their sales of the shares?
No, you are talking from a primary capital markets perspective,
Sir,
or what?
I'm talking in general of origination. Like we can take origination, distribution, and structuring.
Yeah.
Origination, you tell potential.
So 1 minute, let's just also test the origination, distribution, and structuring. These teams, they are important in a PCM context or a SCM context?
DCM.
PC as P as in Patna, P for Patna, right?
DCM and DCM.
Where is DCM coming into the front? My question is whether we discussed 3 types of teams that you can see in an investment bank. Okay, that is origination, distribution, and structuring. So my question is that these 3 types of teams, are they relevant in a PCM context as in P for Patna, or in a SCM context as in S for Singapore? P, right? That is a primary capital markets. Okay, so you're talking about a primary capital markets context where you have these 3 types of teams. Okay, now what is your question?
Sir, like Alibaba is wants to sell their shares.
Yeah.
So Alibaba will able to sell its shares easily. But what will happen in the case of other companies which do not have much name in the market? So how their sales will be made?
See, the point of what is the role of the distribution? Now you're talking about distribution, right?
Yes, sir.
Do you realize that he's talking about distribution?
Yes, sir.
Yes,
Okay, so he's saying that the shares of well-known companies like Alibaba will be easy to sell, okay, but the shares of lesser-known companies will be harder to sell. So you're really talking about a distribution problem. Do you understand that?
They have to find for potential investors.
So that's the role of distribution. Their job is to sell the securities. It's just no different from today. You have well-established brands in ice cream, okay, which are selling easily. Quality or Amul or something will sell easily because everyone knows the brand. If you come out with some new brand of ice cream, naturally customers will be reluctant to try it out because they don't know the brand. So it's the same job that a salesman would have there. Okay, same problem. So that's the role of distribution. Okay, the role of distribution is to, let's see how Alibaba has been doing, because Chinese stocks have not been doing well because of the trade war risks. So Alibaba has managed to hold up reasonably okay compared to what's happening in the Chinese market. Okay, all right. So is your question answered? Okay, that's the role of distribution. Okay, if you're a good distribution team, then you'll be able to sell even securities which are not so well known, of companies which are not so well known. All right. Okay, so we will continue with our discussions. Where were we in the last class? Does anyone? I think we discussed. We were discussing this TAM versus AM, right? Is that right?
Yes.
We were at TAM versus AM. We can move to a. All right. So there is this stuff. If I have not already put it in your folder, all these files you will find in your folder. Okay. This one, then the TAM versus AM. I'll put them in your folder. Okay. Now let's look at TAM versus AM. Okay, what were we discussing? I think we had discussed, it was leverage that we were discussing, right? I don't remember discussing performance evaluation benchmarks.
No, sir.
So we have discussed leverage. Okay, so the leverage notes I have already put in to your discussion on leverage. So this is a bit too big. No, I'll just end, as soon as the class is over, I'll put this into your folder. So you'll have this. Okay, where is this? Yeah, so this discussion that we had on leverage, that has now been put into your notes. Okay, I'll make all this the same font size. All right, now we go into the next point, which is, so when we discuss leverage, if you get position value divided by account equity, if you get a figure of 5 or something, sometimes we say that the leverage ratio is 5:1. Or we just say that the leverage multiple is 5. That's how we would express it normally, okay? All right, so benchmark. So the next point is, what are the differences between TAM and AM when it comes to benchmarks for professional? Okay, what is happening here? Now, Parmeet and Ridhima, same team. I have to deduct. Now, where is Ridhima's team? So you had a fairly low score. Now you're raising your performance level. Okay. All right. Okay. So let's understand this a little bit. Okay. So benchmarks. Now these three, if you notice, I have put these under 5, 6, and 7. Point numbers 5, 6, and 7 are in one particular block.
Yes.
Okay. I put the blue line there. Because they're all connected. Okay, first of all, try to see how they're connected, because obviously there's performance evaluation. So depending on how I evaluate your performance, okay, so because you're getting minus marks for CP, so that's why, so you see that performance evaluation is also connected to risk management. Because you're getting minus marks on CP, Ashil is trying to manage the risk by making sure that nobody in her group is talking, okay, because she knows that it will affect performance evaluation. So you can see that there's a connection between performance evaluation and risk management, okay. So depending on how you're evaluated, you will manage the risk from that perspective. This has a bearing because actually it has a very different implications in the case of TAM versus AM, okay. So and then the last is also compensation. You guys also compensation. Eventually this is also connected to your compensation. So if you get performance evaluation, if you get minus marks in CP, eventually it will affect your compensation, and for you guys as grades, okay. So it will affect your grade. So if your performance is deemed to be poor, so in the industry also what you'll find is that your compensation, okay, compensation is related to your performance. If your performance is poor, your compensation will be less, okay. Yeah, so say that's a classic example. If you see a salesman, most salesmen get a very low base salary and they get compensated as a percentage of sales, so they get a sales commission. So a good salesman, the sky is the limit as far as your earnings is concerned, because if you sell a lot of products, then you will get high income as a percentage of sales. Okay, so compensation is again related to performance, okay. So because you want to, at the end of the day, your main goal is compensation. Your main goal, just like for you guys, the main goal is grades, okay. But then because you know how the grades are going to be affected by negative CP and all that, so based on performance evaluation standards, you manage your risk accordingly. If I had not been giving you minus marks for CP, you guys would be talking more, right? Like in the finance lab sessions, I noticed that when I was listening to the videos, the noise level is much higher in the finance lab, because there's a little bit harder for me to monitor who's talking. So those very high noise levels in those videos. Okay, so first understand that these three are connected. Now we'll go through one by one. Okay, so benchmarks. So in the case of equity, in the case of TAM, okay, the way that benchmarks are done, the performance evaluation in the case of TAM is that the first level performance evaluation is, let's talk about it here. Okay. So what we say is, in the case of TAM, okay, these notes are a little bit, these notes are actually arranged as, I've taken TAM first as one block on top, and then AM is at one block on top, and in each of the blocks I've gone through each of the factors, which you see here. The factors 1, 2, 3, 4, 5, etc. So in each block I've gone through each of the factors, but probably as I was going through it today, it seems better to organize it as you take each of the factors, and then you first talk about AM, and then you first talk about TAM, and then you talk about AM. Go factor wise rather than. So I'll just rearrange those notes. But anyway, you will have the video so you can follow the discussion. Okay. So as far as TAM is concerned, it is what we say asset class specific, long only benchmarks. Now remember what long only is?
Yes, net long.
You can only buy stocks and bonds. You can't go net short. Okay. So what we assume typical, the most. Here, what is written here what is written here in English, I will explain to you visually. Just understand the English first. So who are we evaluating? Whose performance are we evaluating? Long only equity mutual fund manager, which is pretty much the majority of your mutual funds that you see. They are basically long only equity mutual funds. Okay, there may be different types of funds, like growth funds or income funds or value funds or whatever, but they're mostly long only equity mutual funds. Now benchmarking against implied long only buy and hold strategy, broad-based equity index such as S&P 500. If you do this in India, you would use an index like BSE 200 or something. Nifty 50 is a bit narrow, okay, unless it's a particular portfolio that is very, typically you would use a BSE 200 or something like that, okay. So something slightly bigger, broader universe. So anyway, but that again depends on the offer document, how you have communicated it to the offer. But the idea, it will be some kind of broad index, okay. So in the US, if you're managing a small cap, so you have to get this flavor that depending on the class of securities that you're managing, okay. So if in the US you're managing a small cap fund, then you would not benchmark against the S&P 500. The S&P 500 are very large cap companies. So in the US, there's a small cap index called the Russell 2000.
That is for mid-cap companies.
No, Russell 2000 is small cap actually. Russell is considered small cap.
What is for mid-cap?
Mid-cap, I don't remember if there's any mid-cap. Maybe the Russell has some mid-cap stocks also. But so because these definitions are not sort of uniform around the world, so you have to define some cutoff level.
The amount of capital authorization depends the level of authorization, that is medium or small.
Yeah, so typically one of the ways to do it is you take more than 1 billion is taken as, less than 1 billion is taken as small cap. That's one way to do it, okay? But these are not cast in stone. You can sort of, but you have to be consistent. Whatever you set up, you should be consistent over time, at least in the medium term. Okay. So the point is here to understand that you will be benchmarking a mutual fund, okay, depending on what kind of securities it's planning to invest. If it's doing small cap stocks, it's a specialized small cap fund, then you should evaluate it against a small cap index, not against something like the Nifty 50, which is large cap companies, okay. So that is the idea. So this is how it works, okay. What we will do is, we will look at,
the last point.
the point is that your benchmark has to reflect the kind of investor mandate that you have. If your investor mandate, remember the kind of markets that you will invest in. Okay, in this case, the markets will determine, might be stated as you can invest only, in this mutual fund, you can only invest in small cap companies. Okay, so if you can only invest in small cap companies, you should not evaluate that fund, that mutual fund which can only invest in small cap companies, should not be evaluated against a large cap index like the S&P 500 or the Nifty 50 in India. Okay, which is large cap companies. So the benchmark should reflect the kind of fund strategy that you're following, okay, when you're investing. So what we will do is, we'll just take this as, let's take a stock like whatever. I mean, let's take any fund. We take Facebook as an example of a fund, okay. Let's assume, I'm just taking any, because we don't get to chart funds over here. Okay, so if we have this performance of Facebook, then what we are going to do is, we are going to, so essentially let's say that this is just a 1 year period. This is the period that this is the start of the fund, okay, just to make it simple, and this is the ending period of the fund, okay. So we want to see how much it has moved, okay. So it has basically moved from your point here, 45, let's say, 45 to 150, okay. So you see that the fund that you invested in started at 45 and it has ended at 150. So the return is, basically it has made this kind of return. But this point is here is that this is just an absolute return, because you're just looking at the return on the fund. So we say this is an absolute return because you're just looking at the return on the fund, okay. So now absolute is going to be contrasted with the word, what would be the other word? Relative, okay. So it is absolute. Now we are not interested only in absolute performance, we are interested in what is called relative performance, okay. So we want to see, wow, this fund made a lot of money, it started at 45, yeah.
So the basic abstract of this is,
they use the mic. If we have the mic, let's use the mic so that everything gets captured, yeah.
So the basic abstract of this is that we should be consistent our standards. We should be consistent with our standards in this performance evaluation.
Yeah, but this is not really about consistency. This is about the fact that the point here, the point that's being made here is that, yeah, you can come, but you won't get attendance. Okay? All right. Okay. So the point that is being made here, the specific point being made here is, but don't go to the back. Don't go to the back. You sit next to Mittal. All of you go and sit next to Mittal. Or Arihant can remain there. That's fine. Either you sit in Arihant's row or in Mittal's row. Okay. Similarly, you go and sit next to Arihant.
Yes, sir.
Okay. All right. Okay. So we say the point that is being made here specifically is that we are not just interested. The first level, of course, what you look at the first level, the first cut assessment. The first cut assessment is that there is you see the absolute return on the fund. Okay. Now, okay, what is Mittal is talking? Mittal has to get marks. Remember that you won't get attendance, but you can get negative CP. Acha, I have forgotten your name. What is his name? Huh?
He is your marketing and IT.
He is not from finance. Okay, 1 minute. Where is Mittal? Which team is? No, Rahul's group. Mittal has managed to contribute to their score, even though he doesn't have attendance. Okay, this is the beauty of CP. Okay, all right. Okay. Now the point, coming back to Gaba's question, the specific point that was being made there is that obviously when you look at the fund, the first thing you see is the absolute performance, but you can't just stop there, because we are interested in the relative performance, and in particular we are interested in the performance relative to the benchmark. Okay, whatever benchmark we have decided to apply for the evaluation of this fund, we have to see the performance of the fund relative to the benchmark. It is not sufficient to look at just the absolute performance. Okay, that, and then consistency can apply when you set a condition that the benchmark should remain the same. You should not use a different benchmark in different periods. Okay, like first quarter you use one benchmark, second quarter you use a different benchmark, then you're not being consistent. So you can say that is where you would apply the rule of consistency. Is this clear? Okay, so now we said, okay, this fund is performed from $45 to $150. That looks good, but that's not good enough for us. We have to do a comparison. Okay, where is the comparison? Compare. Okay, so what we are going to do is we will just compare this. Now this is being a, let's take this as a Facebook. Okay, so this is all, actually we are not looking at a fund, because I don't think we can get charts of funds here.
So, but that's a whole index and we are comparing it to the share.
1 minute, I'm coming to that. So no, this is actually, we are just assuming that the chart of Facebook is showing the price movement of our fund. Okay, so let's assume this is a technology fund. Okay, this is a technology fund. So so therefore, since it's a technology fund, which of these indices should we use, guys, as a benchmark? Anybody?
Yes, sir.
What is it? Is my question clear? Which, if we are assuming that this chart of Facebook which we are showing, we are just going to make believe that this actually is showing the price movement of a technology focused fund. In this case, what should be the benchmark that we should use out of the option that we are being given?
That is the
DAX is the index in which country? We are assuming that this particular chart of Facebook.
Facebook.
1 minute, one at a time, guys. 1 minute, one at a time. Okay. Your answer is DAX. Okay. Now let me clarify. Let's assume that this is this particular fund invests in US technology companies. Now you said DAX. DAX is the index in which country?
It's a European market.
Germany. Okay. So DAX is the index in Germany. So that doesn't seem to be appropriate. And DAX is a broad-based index in Germany. Okay. Okay. Next, any other option? What can we use?
S&P 500.
S&P 500.
Because Facebook is an American tech giant, so it would be absolutely perfect to make a comparison with the S&P 500.
Okay, I'll just come back to you. Anybody else? Dow Jones. Okay, so none of you have come, even by guessing and elimination, you haven't come to the right answer, which is the NASDAQ 100. Because the NASDAQ 100 is an index of tech stocks. The S&P 500 is a broad-based large cap index. It does not necessarily have a particular focus on technology. So this illustrates the point that we discussed earlier, that when you are doing performance evaluation for a fund, you must know the nature of the fund, and the benchmark should reflect the nature of the fund. So in this case, since the nature of the fund is a US fund focused on technology companies, the best benchmark out of the options given to you here, the best possible benchmark is the NASDAQ 100. Okay, or you can use a larger index which is not shown to you here. There's a larger index called the NASDAQ Composite, okay, which is a larger index, but the NASDAQ 100 is a narrower index. So this is the best option that you have here. So we should evaluate this fund against the NASDAQ 100. Is this clear? Okay, so we set up this thing. All right. Okay. Now what do we see here, guys? We see that there is the fund, the technology fund that we were focusing on. Mittal, you want to lose more marks?
Yes, sir.
What is your problem?
Yes, sir, you want.
Okay. Yeah, you go and sit there. Okay. So what do we see now? We said that it is not sufficient to look at absolute performance alone. We have to look at relative performance. So that's why having seen the nature of the fund, which is a US technology fund. Okay. So we are using the Nasdaq 100 as a benchmark, which is a tech index. So what we see is that the Nasdaq has gone up by 181%, and this fund has gone up by 293%. Is this clear? Okay, so this is one way to do it. You can just take a simple ratio of the two, okay, that you can see the outperformance. So the first level we look at the absolute performance of the fund.
So sir, we can say that our fund has basically beaten the index.
Yes, you can say that now. Here you can say this, okay. It is, so this is you can look at a performance evaluation of a fund can be done in many ways, at many levels, okay. At the first level, you look at the absolute return of the fund, okay. And the second level, you now start looking at the relative performance of the fund. That's what Tushar has mentioned, that this fund, we can say, this fund has beaten the index, okay? Because the index has gone up 181%, the benchmark index, and the fund has gone up 293%, okay? That's the second level, okay? And so this is relative performance. And then you have a third level performance, okay, which is that what you can have a risk-adjusted return. So we should have, maybe we can just do, you can do 3 levels. Return, SS, yeah. So we are coming to the Sharpe ratio at 3 levels, okay. Okay, so 1 is absolute, 2 is relative, and 3 is risk adjusted. Okay, so here we have Sharpe ratio or Sharpe, or there's another one which is Sortino ratio. Okay, so you can actually this is essentially just taking care of so there are 2 ratios here. You can use the Sharpe ratio, which is much more common. People normally don't use the Sortino ratio, but according to me, if you're going to use risk adjusted return, the Sortino ratio is a better one, because essentially these are just, here risk is measured as standard deviation of returns, okay? But there are other ways to measure risk also. What is another way of measuring risk? SD, you will understand, standard deviation. What have you used in your project?
Drawdown.
Yeah, so drawdown is another measure of risk, which is more common in, so this is where you start to see the differences between TAM and AM, okay? In TAM, so again, there are benchmarks also are quite different, the kind of benchmarks people focus on. So the Sharpe ratio business is much more common in TAM, okay? But in AM, it's you will see many people also using measures like drawdown, okay? Maximum drawdown is a measure of risk, what you guys have used in your own project, okay? So that's a different way. So right now we are discussing only TAM, okay? So here we can write TAM here. Yeah, this is all actually about TAM. We can just split up. Okay. So this is so here you can just Google the Sharpe ratio and Sortino ratio. You'll see it in your spreadsheet also where you had submitted the returns. Essentially, what these risk adjusted means, what they're doing is they're looking at the excess return in Sharpe ratio. They're just looking at the excess return of the portfolio. That is essentially your excess return is, what is the excess return here?
So 112.
Yeah, 293 minus 181.
112.
That is the excess return, okay? They'll just look at the excess return and put it in the numerator, and then they will divide it by the standard deviation of this series. This blue series is the return on your tech fund. Here, this is going up, this thing which we have used. So this obviously, this being time series data, this will have a standard deviation. You're just going to see a time series which is 2 columns, dates and prices. So you have returns. Are you following? Are you guys following?
Yes,
you can generate returns. So price in period T is price in period T, okay, minus price in period T minus 1. That's your return. Okay, then you can divide it by the price in period T. Okay, that would be your return. So you just have a series, and then you take that standard deviation of that series. Okay, and that would be the estimate of the riskiness of the return. Okay, so what happens in TAM? in TAM what you're doing is you're looking at, did you guys follow this?
Yes, sir.
We don't need to go through standard deviation and all again. Obviously, if you have time series data, you can generate a standard deviation of that series. So it's nothing but, so this is your price, the fund price, okay? The fund price, so therefore, price in period T minus price in period T minus 1 will give you the return, okay? Divided by the price in period T minus 1, okay? Or you can use natural logarithms. You guys are familiar with natural logarithms? This is something else that is used in finance. Natural logarithms, you haven't done natural logarithms.
No, sir.
So you haven't done logarithms in school.
School they are done.
Log base 10 and all this. And log base E.
Yes, sir.
Yes, sir.
Log base E. So what is log base E? Log base E is a natural logarithm.
It's one.
ln.
Log is one.
Log.
Yeah. So log base E is called a natural logarithm. No, ln. This is called log and this is called ln.
So
Okay.
you don't know the terminology.
Okay, so natural logarithm, you should have known this also. Okay, anyway, so natural, that's another way of measuring the return, that's all. Okay, you take the natural logarithm of the price relative. When we get to option trading, when we'll calculate historical volatility, you will see that. Okay, so essentially it's just this. In Sharpe ratio, what are you doing? You're just taking the outperformance, which is 293 minus 181, is the excess return, and you're just dividing it by the standard deviation of the return. Okay, which is this series. You take this series, you take the standard deviation of this series, and that's your estimate of risk. Remember, so this is the one way of measuring risk, a very common way of measuring risk in finance, especially in theoretical finance. This is all they're doing, okay? They're just looking at, they always measure risk by standard deviation, okay? So you take this return because this is your fund's price movement. So this fund's returns can be calculated from this price movement, and then you take the standard deviation of the risk returns to show you the estimate of the riskiness of the fund. So you're just doing, so what do we mean by risk adjusted return? All we are doing is essentially you're dividing the excess return divided by the standard deviation of the return. Okay, is this clear to everyone? That is similar to this. Remember what we did in your project when we used the AM kind of, this is a TAM kind of evaluation system. It's a TAM way of doing risk adjusted return. In AM, when we did your long short NSE equity trading project, what did we use?
Percentage profit upon.
Percentage profit divided by maximum drawdown. Okay, so it's the same concept. Essentially, on the top, in the numerator, you put the return. Okay, in the case of Sharpe ratio, you're putting the excess return. In the case of our fund, we did not put the excess return. We just put the absolute return.
Yes.
And then we divided it by the risk, by our measure of risk. So risk adjusted return is nothing but return divided by risk. As a general principle, you can write this. Risk adjusted return means this is not 4 actually. Risk adjusted return means the basic principle is return divided DIV is okay. Is this clear? The basic principle in risk adjusted return, whether it's in TAM or in AM, is return in the numerator, either excess return or the absolute return, and then you divide it by the risk. And the measure of risk can be different. In TAM, it is usually the standard deviation, and in AM, you can use other measures like maximum drawdown. So you should not be tied, because in most business schools, when finance will be taught, they will only be taught that risk means standard deviation. Standard deviation is the only way to measure risk. Okay, but that's not really true. There are other ways, which is why I'm telling you about maximum drawdown, which we have used it also, which we have also used in your project evaluation. That there are other ways to measure risk. Standard deviation is just one way to measure risk. And the part I told you about the Sortino ratio. So the Sharpe ratio uses standard deviation. Okay. Now standard deviation, from what you remember from your stats classes, do you think the standard deviation measures both upside deviation, or because standard deviation is going to be deviation around the mean, right?
Yes, sir.
So does it measure both upside or down, both upside and downside variation, or only one side? Both. Okay. So one of the reasons that many people don't like the Sharpe ratio is the Sharpe ratio uses just the standard, the classical standard deviation measure, which means that when the fund is fluctuating, the price of the fund is fluctuating, okay, or the NAV of the fund, you can just think of it, the NAV of the fund, okay, this is going up and down like this. Now if the NAV is fluctuating, the standard deviation is going to capture both upside and downside fluctuation around the mean, okay? And the Sharpe ratio takes that standard deviation as the denominator, okay, as the return, as the measure of risk, okay? But many people say that why should I be worried about upside fluctuation? If it is fluctuating above the mean, I'm not really concerned when I'm making profits. If I'm making, there's a lot of fluctuation, but I'm always making profits above, average profits, then I'm not really concerned. So I should be concerned only with downside standard deviation, okay? So that kind of logic that kind of idea is being put into place by what is called the Sortino ratio. That's why I put Sharpe stroke Sortino, both are ratios, okay? Sharpe ratio or Sortino ratio. Actually, they should be, I don't have to put the bracket, the comma, okay?
So,
Yes.
please explain Sortino ratio again.
Yeah, and we're not going to go into the details of that because that calculation that it uses definite integrals and all that. You guys have done definite integrals?
Yes, yes.
So you've done all that, but you must have forgotten by now, okay? But anyway, the idea behind what you need to remember about what your real takeaway as finance students should be, you can look up these formulas, okay? They are there in your spreadsheet as well. If you go back to your IPM evaluation spreadsheet where you submitted which was given to you. I think I didn't give you that spreadsheet. I just asked you to submit your returns. But essentially, you can check the calculation of the Sharpe ratio. What the Sharpe ratio does, it uses in the denominator, it uses the standard deviation of the fund's return, which is the classical standard deviation, which means it is looking at both sides, its fluctuation above and below the mean on both sides, positive and negative fluctuations. Okay, that's what the Sharpe ratio is using. It is using a standard deviation. Whereas the Sortino ratio is the same concept as the Sharpe ratio, except that it does not take the classical standard deviation. It takes only standard deviation below the mean, okay, for negative returns. So it takes only standard deviation of negative returns, okay. So when the fund is losing money, the standard deviation of those losing periods, okay. So it does a definite integral from minus infinity to the level of to the zero, okay. So this is how the Sortino ratio. But what you need to remember, you don't need to remember the calculation of this. What you need to remember at a broad level is that this is a third level of assessing performance, okay. First is the absolute performance, second is the relative performance to see the outperformance or underperformance, and the third is the risk adjusted performance or the risk adjusted return, okay. And in risk adjusted return you can use either in TAM you would be using the Sharpe ratio, Sortino ratio kind of measures, okay, where you would use okay, what is happening here, Satyam is very active,
but not talking.
very active, but no, he's very active with something, his phone or something like that.
He's not talking.
No, he's not talking, but he's very active. Okay, he's very active on something else. Okay, where is Satyam? Which team? No, Satyam is not Tanu. Okay, sorry. No, not. Okay. All right. Okay. Let's go into this. Okay. All right. So, are you guys following? Everybody's looking kind of blank, like a zombie. No. There is no leaving early. You need to concentrate. You need to apply yourself and concentrate. Okay. You're young people. You have signed up for an MBA program. You need to concentrate and apply yourself because we have not covered a lot of material. In IFM, we should have finished covering a lot of material, including capital raising. So the entire module on capital raising has not been covered. So we will cover as much as we can today, at least so that we can finish this framework. I don't even know if we can finish this framework today. But these are all things you need to be aware of. So please make sure you pay attention and follow what is being taught. Are you following so far?
Yes, sir.
Okay. So just remember these broad concepts. Even that will be an achievement if you can remember it conceptually clearly. But you have a third level of assessment, which is risk-adjusted return. And in TAM, the risk is being measured by standard deviation type of measures. Okay. In TAM. And in AM, we use other measures also like max drawdown. Some people use, even in AM, some people use Sharpe ratio because it's so popular. But it's actually more correct to use measures like maximum drawdown. Okay. So now, in this, as far as the measurement of risk is concerned, you should also be aware that there is a refinement. So the basic structure of this calculation of risk-adjusted return is return on top divided by the risk measure. That is the basic formula, okay? If you look up the Sharpe ratio formula, you'll see that's the basic formula. Return on top, either absolute return or excess return, okay? And in TAM, typically we will use the excess return on top divided by risk, and the risk measure is standard deviation, and Sortino ratio improves on the standard deviation by considering only the downside standard deviation. You follow the logic that we are not concerned with, you could say that we are not concerned with upside standard deviation. Because if I'm making returns, if I'm making positive returns, why should I worry? Even if it fluctuates a lot, okay? So these are the things you need to know. Okay, so in the case of AM, what is happening? So the main difference is that here. So benchmarks for performance evaluation in TAM you have this, okay? And here you typically get some kind of a benchmark. This is called a hurdle rates. Okay, you can use the hurdle rate. Okay. All right. So in the case of TAM, in the case of AM, what is happening is we are not using that kind of asset. We should not be using, actually. Some people still use it, but it's not a correct way. The correct way to look at is the performance return in excess of some kind of opportunity cost. Like I gave you the example of Oak Tree. We mentioned Oak Tree, which is Howard Marks's company, which is a very famous distressed debt investor. Okay, so they are a value investor in the debt space. In this asset class called debt, they are actually a value investor. They wait for prices to fall sharply below what they think to be the fair, assessed to be the fair value, and then they go in and pounce. So they wait. Basically, most of the time they're waiting. They're waiting for a market panic. Okay, and waiting for prices to be sold off heavily. And then they will go and pounce, and like they did in the financial crisis. What they did in the financial crisis in 2008, before 2000, in 2007 itself, they raised a large fund, about 100 billion, over 100 billion or something like that. And then when they were waiting, because they knew that there would be some kind of crash because prices were too high. So they were waiting. As soon as the crash came, when everybody was selling in a panic, then they went in and bought. Okay, because the prices were deeply discounted. Okay. So that's the idea, that's how a value investor operates. That's also how Warren Buffett operates. The difference between Warren Buffett and Howard Marks, both are value investors, but Buffett operates mainly in equities, and this guy operates in debt, okay? But their basic thinking is the same, all right? So these guys, now Oak Tree has a hurdle rate, which is now around 8%. So the hurdle rate in performance evaluation, now you see what they're going to look at is that they're going to look at some kind of absolute return, which is, some kind of opportunity cost. So hurdle rate for Oak Tree means that Oak Tree doesn't get paid. Remember that this is tied to compensation. Okay, so this is tied to compensation. So these guys, so if you have a hurdle rate of 8%, okay, what that means is that Oak Tree will not get any money, any compensation, unless they make 8% at least. So you get paid. You understand what a hurdle is? Remember 100 meter hurdles or 110 meter hurdles, right? You remember that race, right? So you have to cross the hurdle, which means, so hurdle rate of 8% means they don't get paid if they make only 6% in a year. They don't get any compensation because they have not cleared the hurdle rate. Okay, so if they make 14%, then they will get paid, and if the hurdle rate is 8%, then they will get paid on the assumption that they have made 6% excess return. So they will be paid according to only that 6%, which is only the excess that although they've actually made 14%, okay, as an absolute return, okay, but here they're going to be paid only according to the 6%, which is the excess return over the hurdle. Okay, so the hurdle, you notice here that this is kind of like a benchmark. The hurdle is operating like a benchmark, just like here we are saying that your technology fund has made about 112% excess return. Why? Because it's 112% better than the benchmark. Performance is better than the benchmark. Okay. In this case, we don't set. In the case of TAM, we don't set a asset class specific benchmark. Okay. Like in this case, what we are setting is, if you see here, why does it say asset class specific long only benchmark? Because this was a technology fund investing in equities. So we took a technology index like this one, the NASDAQ 100. We took a index of technology companies, and it's a stock index. It's not a bond index. Okay, so NASDAQ 100 is basically the stocks of technology companies, the equity shares of technology companies. So we took the asset class specific, and we assumed that instead of investing in this technology fund, what if we had taken that money and invested it in the technology index? So it's a what if kind of analysis. When you're doing a benchmarking, it's kind of like a what if analysis in some way. Okay, so you assume that, you know, if you ask this question, what if we had invested in this index? Well, it turns out that if you had invested in the index, you would have made 181%. But by investing in the fund, you have made 293%. So the fund has outperformed by 112%. Okay, the same thing, same kind of broad thinking is going to be applied in TAM also, in AM also. But in this case, our benchmark is not some kind of technology index or some distressed debt index or anything like that. It is going to be some kind of absolute return, like this you can see in the case of Oaktree. The hurdle rate is 8%. So if they make 14%, they won't be paid on the basis of having made 14% because their hurdle rate is 8%. So their compensation is going to be really based on the outperformance, which is the 6%. Okay, so this hurdle rate can be set in many ways. It is the main idea in the hurdle rate is again to reflect some kind of opportunity cost. Okay, that if I'm an investor, why should I invest with Oaktree? Instead of investing with Oaktree, I could have taken my money and put it into treasury bills. It's a safe asset. I could have just bought US Treasury, US government bills, Treasury bills is basically part of the US government. So US government obligations, so I could have just invested in treasury bills, and maybe I can make 2% or 3% by investing in treasury bills. So I could set that kind of a benchmark as well. In this case, they have set it at 8%, which is basically, it's just meant to reflect an opportunity cost for the investor. So it's clear? This is the idea behind the benchmark. Okay. Alright, so these are sometimes called hurdle rates also. So this is another way of doing it. Okay, what I would just say here is that, so AM is just alternative asset managers in this case, okay? Use benchmarks similar to TAM but this is not correct actually. You will find very often in the media when you're listening to Bloomberg News, they might talk about some particular hedge fund, okay? They might say that hedge funds have produced only 0.2% this year, okay? And they will compare it to the return on the S&P 500 and they'll say the S&P 500 has produced 16% returns this year. So they're effectively using the S&P 500 as the benchmark, but that is actually not conceptually correct, okay? Some fund managers also do this, but the correct way to measure AM funds is again some kind of absolute return benchmark, okay, which they have set. Typically, the best way to do it logically, according to me, is to set some kind of alternative which the fund manager, which the investor could have used. Instead of investing in a hedge fund, I could have put my money in US treasury bills. Okay, if you take an annual perspective, every year you evaluate the performance. So at the beginning of every year, I have two options. I can invest my money in a hedge fund, or I can just put my money in 1 year treasury bills. So when I look at whether the hedge fund has actually done well, I will compare it to what I could have got by just investing in pure risk-free treasury bills for 1 year. So if I could have got a 3% return in the treasury bill for 1 year, and the hedge fund has made like 4.5%, so I'm not going to say that you guys are great, you made 4.5%. You actually made only 1.5% excess return over the treasury bill, which is my opportunity cost of investing in your fund. Instead of, because I'm investing in your fund, now I cannot invest that money in the treasury bill. Okay, so that is the idea behind the setting up of a benchmark. Okay, so some people do use the S&P 500 even in AM, but that's not actually correct. Okay, so I'll just say this is incorrect. Okay, conceptually it's incorrect. Okay, so return, this is already mentioned and is already discussed with you. Okay, that returns in excess of opportunity cost. This is happening in the case of AM. Okay, this is in the case of AM. Okay, are you following the structure of this note? Now I'm just trying to rewrite the note that this is the point that is being discussed, benchmarks, and then we are discussing it separately for TAM and for AM. Is this okay? Is this okay? Okay, there is an article there as well. I'm not going to open it because this is now behind a paywall, so you can open it and read it on your own. Okay, so the two ways that you use benchmarks and AM Either you use some kind of absolute opportunity cost, some kind of opportunity cost measure like return on treasury bills, or you can sometimes compare it to a peer group. Again, this is not very, not ideal. This is the best way to do it. Okay. Sometimes you compare it like if you have, for instance, what is meant by peer group? You understand what is peer group? Same class of people. Okay. So if you have, so you might actually, if you are evaluating the returns for Oak Tree, suppose Oak Tree has made 14% return in a year. Okay. One of the ways you can evaluate their performance is to look at now what kind of fund is Oak Tree? It's not it's not investing in equities. Okay, it's not investing in currencies or commodities. It's a pure debt fund. Okay, and in particular, it actually is it's a fund that focuses on the credit play. Okay, so but it's a debt fund. Okay, so and it's mainly a distressed debt fund. So you would compare it to its peer group so that you would look at what is the average of. There'll be other distressed debt funds in the market. There'll be other funds like that who are trying to do the same thing. Okay, so you would look at the entire universe of distressed debt funds or other debt funds which are trying to, credit-based funds. Okay, we're trying to play on credit risk. So you would look at that universe and you would see maybe that the average return on those funds is maybe, let's say, 11%. Okay, so then you will say that Oak Tree has outperformed its peer group by 3% because they've made 14%, and the average return of the peer group is 11%. Are you getting the idea? Okay, it's the same kind of idea that you have to compare like for like. You can't compare apples to oranges. It's the same idea when we discuss the return of a small cap equity fund. So we said that if you are evaluating the return of a small cap equity fund, you cannot use a benchmark which is like something like the S&P 500 or the Nifty 50 in India, which are basically large cap indices. So if your fund is a small cap fund, you should not see the return of that fund in relation to a large cap index. It should be a small cap index. Is this clear? So like for like, that's the basic idea. Okay, so peer group investing, and this is also, according to me, also not really the correct way. The correct way is only the 5A. Is this actually 5? Yeah, it is 5. So it is the correct way is only 5A, but this is less incorrect than the others. So I'll put then the previous one. So I'll put incorrect with a question mark. Okay. Now 5, 7 is compensation. What is 6? 6 is risk management. Okay, this is also very important to understand. Okay, that so you have to understand is that risk management is connected to how performance is being evaluated. Okay, so in TAM, the risk management, you will hear this term called tracking error. Have you heard this term? Some of you worked in your summer projects with people like SMC.
Tracking error maybe not being up to date.
Use the mic properly.
Tracking error maybe means maybe not keeping update to the market properly, like day to day.
Yeah, sort of, almost correct. The tracking error is nothing but your tracking. Remember, what is your benchmark in TAM? Your main benchmark in TAM is if we don't get into the risk adjusted return part at this point, okay, if we are looking at only the first two levels of assessing return, okay, we're looking at absolute return and relative, especially the second part, okay. If you're looking at this, because this is a very important focus, to what extent have you underperformed or outperformed relative to the index, okay. This is one of the very important ways of evaluating the funds, okay, of evaluating different funds. So therefore, tracking error, this is a term that you need to be familiar with. Tracking error means the extent here. This is tracking error. Here there's not much tracking error, but here there is tracking error. You could say that at this point, if you see that the fund when it first began, tracking error is just the extent to which you are actually underperforming relative to the index. Okay. All right, okay, or you could take it as, you could, if you have a positive tracking error, normally we should not use that term because error means negative, okay, error implies negativity. So tracking error means that here, if you look at this part here, where the benchmark is actually rising, the benchmark is rising, but the fund is falling. So here you have tracking error. So tracking error focuses on really the second type of, the second level of return assessment, which is the relative return. So in tracking error, what you're doing is you're looking at to what extent am I underperforming the index. Okay, So some people use tracking error in both senses. What is my performance relative to the index? So even if they have a positive, even if they're outperforming the index, they say we have a positive tracking error. But according to me, that's not a correct way of using the term, because error would necessarily imply negative performance. Okay, so tracking error should be taken as only underperformance relative to the index. So when you're looking at risk, it's the same thing with respect to risk. Some people think that any kind of fluctuation is risk, but I would say that only downside fluctuation is risk, only when you're losing money. Okay. So the focus of TAM funds, because TAM funds are all going to be evaluated on relative performance to the index. So all they care about, okay, that see how this leads to very perverse results. Okay, the TAM managers, all they care about is performance relative to the index. They don't care about positive absolute performance per se. Okay, so that means in a negative period, okay, if you look at this, if you look at a negative period, which is, you don't see it here because Facebook came out after the, if we change, I don't think we can change Facebook here. We don't have an option of changing Facebook. We don't have the option of changing Facebook here, but anyway, the point is that you remember that in the let me just remove this for instance. Okay, let me take a stock on, and then we don't have remove this. Okay, let me take this as let me take a stock on which we'll have a lot of history. Okay, let's have MSFT. Okay, now let's have GE. Okay, and hopefully we have a lot of history on GE going beyond. Let's see if we have 1 week data, and then we go into the, yeah, now you see this, we cover the financial crisis. Okay, now let's see, see the point, assuming now let's assume that this is your fund. Okay, this is your fund. Okay, so you would assume that when this fund is falling, like this is what year, 2000, this is what, this is 2008. Okay, so here your fund is falling, right? Your fund is falling here, losing money. So the point of tracking error being the focus of risk management in the case of TAM is because they are only evaluated relative to the performance of the benchmark. Okay, so they don't really care if they're losing money, because as you can see here, if we compare this to the, in the case of GE, what can we use? We can use either Dow 30 or S&P 500, because Dow 30 is again very large cap stocks, and GE was, at least at that time, a large cap stock. Now it's in all kinds of trouble. Okay, let's do this and see. Okay, now you see something here. What are we talking about, guys? Let's understand this. Let's understand what is meant by tracking error. You see this part here during the financial crisis when Lehman was going bankrupt here, September of 2008. What is happening? The fund is falling.
Yes.
And the benchmark is in orange. What is happening to the benchmark?
It's rising.
Benchmark is not rising. Benchmark is also falling. Okay.
That particular day.
Yeah. If you look at this, let's focus it. Let's zero in on this. Okay. Let's try to focus in on this. My computer might be hanging here. Okay. Yeah. You can see here what's happening, guys. And this is the time when so Lehman went bankrupt. I think around 15 September 2008. Okay. Yeah, this is the time. So what is happening after this? The fund is falling, the fund is in blue, and the index is also falling.
Yes, sir.
Okay, now the returns may be a little bit different. Okay, the negative returns may be a little bit different. Okay, but let's assume that let's, for the sake of the point, the first point to note here is that on the face of it seemed like there was a problem because our fund was falling in value. But then we look at, remember, we are not going to be evaluated on an absolute return basis. We are going to be evaluated on a relative return basis, okay? And then finally on risk-adjusted return. But relative return is one of the most important ways of evaluating funds, okay? So then I look at the index, but what's happening to the index? And let's assume that, for the sake of argument, we are going to assume that, let's say, year to date, our fund in September is down 25%, okay? But let's assume that year to date, the index is down 30%. Okay, so actually I'm a hero because I'm outperforming the index. You realize that?
Yes, sir.
Because I'm down only 25%. The fund is down 30%. Sorry, my fund is down only 25%, but the benchmark is down 30%. Okay, so this is the problem of TAM. This is one of the problems of TAM. because they are only concerned with outperforming their benchmark. They are not concerned with absolute return as such. Okay, so this obviously, as an investor, are you going to be happy like if this is what is happening to your fund? If you've invested in the fund and the fund manager tells me
on the initial stages we would have.
no, if you have invested in a fund and the fund is down 25%, but when you call up the fund manager, he says, don't talk to me, I'm a hero because the market is down 30% and I'm only down 25%. Is this something that's going to make you happy as an investor? No. So this is one of the problems of TAM that you should be aware of. That TAM managers, because again, everything is driven by incentives. Okay, why are you trying to keep quiet in the class? Why is Achal managing people? Because it's all incentives. Okay, because you know that if you get caught talking, you will lose marks, and that will affect your grade eventually. So your compensation gets affected. So your performance evaluation is negative. Compensation gets affected. So it's all about incentives. So because we are incentivizing mutual fund managers, which is basically the large universe of TAM people. Okay, we are incentivizing them to perform on a relative performance basis compared to the index. So that's all they care about. Okay, so the index is down, they're also down, but as long as they're down less, they're happy. Okay, so this is one of the perverse kind of results that you get in TAM. Okay, you have to be aware of this. Okay, in the case of AM, what were we using as a measure of risk? Absolute, no, what were we using as a measure of risk? As a measure of risk? Drawdown, okay? So what is drawdown now? If you are losing money, you are automatically focused on drawdown. Do you realize this? If you are losing money, then that itself is drawdown.
Yes, sir.
So that means you become focused on any kind of loss in your own fund. Because your risk measure is actually, you're not being evaluated relative to a particular benchmark. You have a hurdle rate obviously to meet, okay? But because your risk measure is drawdown, they tend to be much more focused on absolute losses. Whereas in TAM, you're not so focused on absolute losses, you're focused on losses relative to the benchmark, okay? So the tracking error, this is basically in TAM what we call tracking error. Tracking error means if your index is down, if the benchmark is down 30%, okay, and you're down 35%, then you have a 5% tracking error relative to the index. Because the index is down only 30%, but you are down 35%. This is clear, okay? So, but in app, people tend to be much more focused, especially the futures fund managers. They tend to be much more focused on absolute returns, absolute losses also, okay? All right. So compensation. So is this point clear now? Risk management. So you have to understand the linkages between the various factors, okay, especially these three factors, 5, 6 and 7. That the way you decide to do performance benchmark performance evaluation, and then compensation is tied to performance evaluation, and then the way because compensation is tied to it, it affects the risk management behavior. So a TAM fund tends to be focused only on tracking error. They are not really bothered if they're down on an absolute basis. They are focused only on tracking error. Whereas AM funds tend to be much more focused on, because the drawdown aspect is going to come into the return calculation. So they are much more focused on absolute losses. Okay. Now the third part is compensation. Typically, how is compensation done? Okay, compensation. Yeah. So in the case of TAM, we'll just copy this. You understand this expression called AUM? Yeah, AUM is assets under management, okay? All right. So in the case of TAM, compensation is how is the fund manager going to get paid? So in the case of TAM, some of you might have been investing in mutual funds. They would typically charge a percentage of the assets under management, okay? So in mutual funds, you'll be charged a percentage of assets under management. And then okay, there is a difference. We will come to the difference between passive versus active. Okay, passive is basically your ETF types. Okay, active is your traditional mutual fund. All right. Active mutual fund means simply that, like say your HDFC mutual fund. Okay, they might have a growth fund, HDFC growth fund. Active means that the fund manager is taking active decisions to, even though he may be evaluated against, let's say that the HDFC growth fund is going to be evaluated against the Nifty 50. The benchmark for that particular fund, okay, so you take the HDFC growth fund, their benchmark, let's say, is the Nifty 50, okay. The meaning of active is active portfolio management versus passive portfolio management, okay. So active versus passive versus active portfolio management. This is a term that comes up in our last point in discussion. Passive versus active portfolio management. Try to understand this. What is passive versus active? Active means, okay, first you understand, okay, HDFC growth fund, their benchmark is going to be the let's say the Nifty 50 stock index, okay. Now what is going to happen in the case of the in the case of the HDFC growth fund is going to be evaluating a Nifty 50 stock index. So one of the safest strategies for this fund manager is to minimize tracking error, to have no tracking error at all, no risk of tracking error. The safest thing he can do is he can just buy all the Nifty 50 stocks and sit on it. You understand this?
Yes, sir.
Because he's only going to be evaluated against performance of the Nifty 50, so he can just buy the Nifty 50 stocks in the same proportion, okay, as they are on the index. So then he can never have any tracking error. His tracking error is always going to be zero, because whatever happens to the Nifty 50 index, he's just monitoring that, he's just following that. Is this point clear?
Yes.
Okay, so this safe strategy. This is called,
Positions change after a certain period, right?
No, 1 sec. What I'm saying is, if he wants to be very, very conservative, if he wants to play it really safe, because he's going to be evaluated against the benchmark, which is Nifty 50. Okay, so the safest thing for him to do, I'm just taking an extreme example, then we will look at other variations. What are the options open to him? One option that is open to him to minimize tracking error is to just say, okay, I'm just going to buy the same stocks in the same proportion as they exist in the Nifty 50 index, right? So now I'm safe. You can't touch me because my tracking error will always be zero. Okay, it can only be positive, it can't be negative. Okay, with the same stock. Now this thing is called closet indexing. Okay, you should know this term as well. Okay, since I've explained it, I'm not going to write it here. This is, if what you are doing, if an active portfolio manager, actually what he does is, instead of actively selecting some stocks, he just mimics the index by buying the stocks. No one can stop him from doing that. Okay, but if he does that, this is called closet indexing. Okay, so the term closet comes from the expression that, when people come out and express their true nature, then we say they've come out of the closet. You heard the expression?
Yes, sir.
Right? Like when gay people come out and say I'm gay, like Tim Cook said, so we say that he's coming out of the closet. Okay, so that's where the expression comes from. So closet indexing means you're actually pretending to be an active portfolio manager, but you're actually just a indexer. You are just mimicking the index. So that's why we say closet indexing. Clear? Okay, so this expression, this behavior is called closet indexing. Okay. Now the other option that is available to him is, if he really wants to be an active portfolio manager, is he will select a bunch of stocks which he thinks are actually going to be growth stocks, which may not reflect the stocks in the Nifty 50. It could be a different set of stocks. Okay, so then now two things can happen. He may turn out to be right and his portfolio might do better than the Nifty 50, but he's also taking a risk because he may turn out to be wrong. His portfolio that he selected might actually do worse than the Nifty 50. Is this clear?
Yes, sir.
Both types of outcomes are possible. Now what he's doing, if he does this is called true active portfolio management. Active portfolio management essentially means that you actively select a mix of stocks which do not reflect your benchmark index. Okay, so HDFC growth fund benchmark index has been set as Nifty 50 stocks. So typically we would expect a true active manager to select any number of other stocks which are growth stocks, but which do not necessarily make up the Nifty 50. So he should not, basically an active fund manager should not be engaging in closet indexing. Are you following? Closet indexing, you know what it is. You pretend to the world that you are an active manager, okay, and then you actually are just mimicking the index.
Mimicking the index
behind the curtains.
Mimicking means you're just doing whatever, if he does this, then I also do this. Mimicking means I'm doing exactly what the other person is doing. Mimic means that, basically, right? Yeah.
So it is like behind the curtain strategy.
You could say that, yeah, it's behind the curtain. That's why we say closet. Closet, you understand? Closet is basically where you put your clothes, it's covered. Okay, so that's why, right? So is this clear? Okay. So essentially you can understand active investing by understanding first closet indexing. Active portfolio management. In order to understand active portfolio management, it is useful to first understand what is closet indexing. Closet indexing means you're pretending to the world that you are an active portfolio manager, and then you are actually, what you're doing is you're just mimicking the index. You're just replicating the index, okay? But you're pretending to be an active portfolio manager. So that's why it's called closet indexing. Just like when gay people, like everybody thought Tim Cook was straight, but then he came out of the closet and told people that he was gay. So that's why we say he's come out of the closet. Okay, so that's the expression that is used. So if active portfolio management, essentially what it means is that you are not a closet indexer. You are actively selecting stocks which are different from what is there in the index. So you take the risk that you could have some kind of tracking error. Okay, that's what is active portfolio management. Passive portfolio management is basically just investing in the index. Okay, so I've given you ETFs. ETFs probably is not a best way, though not the best way to investing in the index. So what I do, some of the ETFs are actually including through ETFs. Okay, some ETFs, like one, I'll just give you an example. People are getting restless. 3 minutes, 2.5 minutes, 1 minute, 1 minute. Let me just explain. 1 minute. Let me explain one little thing. One last point. Okay, one last point. Okay, SPY. One sec. Investing, passive. Understand the difference between active and passive. Okay. So passive portfolio management is nothing but just indexing. It's also called indexing. Okay. So what you do in passive portfolio management is, like, this SPY is an ETF. SPY is a very famous ETF. Okay, most liquid ETF in the world. It mimics the S&P 500 index. Okay, so it's an ETF that follows the performance of the index. So instead of investing in active mutual funds, active portfolio management funds, you just invest in an ETF like the SPY, which just mirrors the S&P 500 index. It will replicate the index. So here the advantage, why do people do passive management as opposed to active management? Because the fees are less. Okay, I'm not going to write this, but the reason that people do, remember that you pay in compensation for TAM is percentage of AUM. Okay, but in active portfolio management, the fees are higher. So an active mutual fund might charge 1% of AUM.
Like expense ratio.
Expense ratio, that is basically
expense
it.
ratio.
Expense ratio is basically the compensation.
Yes.
Okay, so expense ratio, you will notice if you study mutual funds, expense ratios for active funds, active portfolio management funds, are higher than the ratios for passive funds.
Because active is managing more risk.
Active is taking more decisions, doing more analysis. These guys are just replicating the index. Is this clear?
Yes.
Okay, good. Now you've all become experts in finance, and you owe me 15 seconds.
So in the
Okay.
last two classes, you owe us
Okay, fine, no problem. So I'll see you in the term after the next semester. Yeah, okay. All right. Okay. Yeah. Happy Diwali.
Index technique is a part of classifying